Thank you. So we are now heading for the final presentation and the final intervention for today before handing over to Doug for the final awards. And here we are talking about the evolution of distribution channels. I'm Francesco Burelli. I'm a partner of the company called Arkwright. So what we have as a list of content, we're going to talk about the proliferation of channels over time, the dynamics in branch ATM and mobile, the key channels, the impact and expectation out of COVID before reaching some conclusions. As a word of introduction, Arkwright is an advisory firm of Scandinavian origin. I'm one of the partners. I am based between the UAE and Dubai. We operate globally out of 3 offices, and we got consultants located in a couple of other countries around the globe. Without any further ado, let's dive into the content. So distribution channels have increased significantly in number and complexity over the last 20 years. This is because of the growing number of interfaces and business models that are being enabled by technology and industry convergence. So in fact, if we look at the evolution over time, we had in year 2000 a concentration on innovation that has been taken to market with the initial mobile devices, with the introduction of Facebook in 2003, iPhone in 2006, and so on, that have created, made available new ways of interacting with consumers and new platforms. We got the conversational devices like Amazon, Alexa, and so on that have started emerging around 2011, 2012. Virtual reality is something that has been developing over time, but in particular with the fast connectivity of 5G, we expect to come of age. So overall, technology has led to a proliferation in the distribution channels. In fact, historically, in the late 90s, when I started as a banker, we had branch and ATMs, telephone banking, starting being rolled out as the great innovation of those times, and white labeling third-party distribution agreements with, in particular, consumer credit, looking at point of sales distribution and white labeling of contract. Now, over time, we got online and aggregation. Online started appearing in 2003 with companies like Egg, looking at ways of putting together information from different accounts through scraping. A type of business model that is now evolving with open banking and APIs and availability of information with different channels. We got third-party comparison marketplaces. Once again, these are initiatives that initially were taken to market by third parties, comparing banking products and practically disintermediating the banks by making it easier through a non-banking interface for consumers to compare value proposition. And these type of models are in many countries now being taken back in control by banks that are aggregating their own product as well as offering information about the product or products of competitors, like it is the case in Germany for saving products, for the saving accounts, by financial organizations that way are retaining control of the customer, the ownership of the customer contact. We got social media. Social media has been one of those channels that have created some challenges in terms of a cultural and organizational approach to how you handle the speed of response in an environment that is highly regulated by compliance and that typically is controlled by a hierarchy of ability to take decisions that in the case of social media has been put to an instant type of environment. Then we have the platform marketplaces and the conversational commerce. There's a lot of financial institutions that in particular in the US have now adapted and interfaced with devices like Alexa in order to offer voice interface. And then finally, we got the cross-industry ecosystems. These are business models that in reality have existed since the 90s, but it is the new opportunities provided by technology that has made them of age, and in particular with the establishment of the super app in Asia, has started becoming more prominent to the point that now they are one aspirational point of development and target for many organizations. So overall, if we look at the banking industry very similarly to retail, we got a decoupling from the customer touch points in terms of the product life cycle. The information search, the inquiry, the application, the use, the service and support, complaint handling, and the closure across a variety of channels, leading to multi-channel banking, the challenge of cross-channel single customer view, and cross-channel customer experience. So overall, with time and technology, we have, yes, way more ways of interacting with customers. We have ways for customers to be much more in control of the information and of the products and their holdings. But on the other side, from a banking perspective, we have a proliferation of complexity from a technology, organizational, and process perspective. Now, we are in the middle of a pandemic, COVID, and the market and the industry is dealing with it with expected long-term in customer behavior. If we focus on the channel, there is right now a lot of expectation, a lot of marketing effort and messages that are pushed through with a push away from cash, payments becoming contactless and all digital, and so on. In reality, COVID is causing negative effect on consumer and employment, reduced availability, willingness to spend, negative sentiment, as well as trade. Cybot is happening this week in parallel to this event. And I was hearing a speaker from one of the major banks talking about trade and the trends within the pandemic, where we have seen falls in specific corridors between 30 to 40%. So this is way less economic activity that will have an impact on customers. And the pandemic is, yes, indeed, driving a change in channel behavior from the customers, putting obviously slow-moving and underinvested in digital players in difficulty while creating capabilities for others. But in here, for example, we are seeing a trend in a number of markets where digital-only, mobile-only new entrants have lost a bit of an edge compared to the comfort and the security that the incumbent players are offering to the market. Branch interaction will continue dropping, but will persist for high value, moment of truth type of interaction. Whenever has a difficult problem to solve or an highly emotional product to buy, the branch is still playing a significant role. And yes, we've seen a spike in first-time digital adoption, but also in parallel to that, we are currently seeing a spike in call center traffic throughout a number of different markets. Now, if we look at ATM penetration, commercial branch penetration, there's a typo on top of the slide. Apologies for that, just spotted it. Now, looking at the branch trends in the Southeast Asia region, we got a bit of a different type of situation with countries like Cambodia, like India, where the branch penetration has been increasing, while for other markets, the branch availability for 1,000 people based on IMF statistics has decreased a bit over time. And obviously we can understand that as banks are trying to optimize their cost, and branch being an investment and asset intensive type of channel, there's a move away from that as customers are moving to digital channels. But overall, if we look at the last 20 years, or at least the last 23 years I've been in banking myself, there's been a constant effort and investment in redesigning branches, in improving customer experience through a mix of self-service, assisted self-service, and high-value teller-led or consultant-led interaction. There is an ongoing reconfiguration of the branch network and formats, and the related need to provide coaching to customers on how to use it. There is an increasing constant effort in getting employees up to speed with the digital skills so that they are proficient in using the same application that the customers are using. And then whenever it is appropriate, as very often the customer is sharing the screen together with the consultant, there is an element of user experience in getting the look and feel being logically and graphically consistent with the apps that the client has access through its own channels. So overall, the branch can be considered an high-value touch point within the context of balancing decision and information control that otherwise would be completed in the customer and in the intermediary ends. Looking at ATM usage has been decreasing as customers have been keeping moving into electronic payments, either by replacing cash with cards in a shop, or simply because commerce has been moved away from shops into electronic channels where an electronic payment method is the prevalent method for completing a purchase. In fact, what we got over time is a number of countries that have seen ATM utilization decreasing over time. And it comes to no surprise that these are the countries where ATM penetration is also going down, or there are initiatives such as consortiums, for example, in the Netherlands, or ATM reduction in terms of number of installed units in the UK, and so on. But it should come to no surprise that government and consumers have not been uniformly very happy with this, simply because cash still has a play in terms of financial inclusiveness and choice for consumers. So even in countries like Sweden, the preeminent economy that is considered to be going cashless, there is an element, there's been an intervention from the government safeguarding access to cash through these type of channels. And as consumers are moving more and more into digital, we are seeing that channels like the call center and channels like the ATM, where there is a physical to digital point of interaction, are becoming more crucial, not just in the branch innovation, but also in the overall user experience. So ATM numbers have been growing, have been decreasing, but over time, there's also a change in the business model that this type of channel can be handled through by banks. So we see historically in-house own and run type of solution with a little bit of outsourcing that now are tending to go either into the direction of a lease and a sale and lease back, or on the direction of a consortium in different type of configurations, going from processing consortiums to the full spinning off of the ATM utility, serving a multiple number of organizations. Belgium is going in that direction. Switzerland is going in that direction. There's a couple of countries in Southeast Asia and Asia Pacific that are also moving in a similar direction. And in here, what we've seen combined to the overall cost of the estates, a potential saving in the 20 to 40%. So there's a strong justification for these type of movements. Talking about mobile, mobile is center stage when we think about future channels for banking. Now, if we look at the Southeast Asian region and at the percentage of users of mobile banking within a banking population, we got to extremes. We got Thailand on one side with 77% of bank customers using mobile. On the other side, we got Japan with 24%. Now, overall, the region is on the high utilization level. And this is probably because of factors that have enabled the rise of the super apps, mobile commerce being so prominent, conversational commerce to be so prominent in in the region, to the point that Asia is absolutely driving in terms of state of development, the industry on a global basis. So mobile banking is already very popular, is keeping attracting users due to the familiarity and availability of not just of the device, but the immediacy in accessing the information. But on the other side is creating security challenges that are very much of importance for customers. They are part of the moment of truth. And on the other side are also absolutely fundamental for the industry. Now, these type of devices are not just a channel to provide access to the financial services holding the current account and so on through an alternative type of online devices. They are also very much core to the lifestyle contextual value propositions that have been developing over the recent years. And let's not forget that the voice activated assistants are moving from the dedicated devices into the mobile, in particular as the speed of connectivity is going to improve and get much faster with 5G. This is going to open up a completely new set of opportunities and risk for the industry. Now, if we look at business models, so there's two different parameters that we can look at. So the first one is what constitutes value and how the value is realized. So we have the value that is product or service that can be realized on a simple proposition, either on one-off or through a number of different touch points. Like, for example, is the holding of my current account and using it for the various payments. On the advisory side, there's an element of advisory that is aimed and finalized to the customer choosing and using at best a specific product. This is the area, for example, where insurance is operating specific level of mass affluent and high net worth private banking is positioned, where private equities are operating in as well. But there is an outcome-focused spot area that is dependent on an advanced proposition and the value being released for all the participants throughout the journey. That's where the platform, marketplaces, and ecosystems tend to operate. Now, as I was saying earlier on, platforms and strategic alliance ecosystem have been in existence for over 30, 40 years, but have now gained significant prominence. And this is where we are seeing the region in Asia coming up with lifestyle applications that provide customers the ability to handle all of their daily dealings or specific set of customer journeys throughout one single interface, with the payment becoming invisible, and a number of different touch points that are involving players of completely different nature and category. In here, we have a number of different business models, including platform and marketplaces, strategic partnerships. Open banking falls also in this category as part of the aggregation value proposition. Now, the reason why I mentioned the business model is because the business model in this case is very often not just a channel, but part of the value proposition for the customer itself. And this is where financial services companies and banks are having a chance to retaking control over a platform out of a disintermediation that they've seen and they've been subject to over the last 20 years. These models obviously are not simple to implement, but their value is quite significant. Now, we've been talking about a number of different channels and we've been touching the pandemic. So how are these expected to change in terms of utilization and customer behavior over the next few years, as hopefully next year we will enter into a different phase of the pandemic with a vaccine and cure that are going to start emerging and being rolled out. So probably there will be a hope to go back to a life that was a bit similar to what it was before? Well, if we take the UK, a market that has a high penetration of mobile banking use and online internet banking use, where branches have been decreasing and ATMs have been decreasing over time, with banks looking to optimize cost, we have a situation in which there's going to be some trends in consistency in terms of trends that are either decreasing or increasing in terms of adoption. But overall, there is not an expectation that these are going to be completely reshuffled with sudden changes. So overall, these channels, despite cash substitution, are not going to become redundant. There's still going to be complementarity between them. So, and despite an increase in online banking, internet and mobile, there is an accelerated shift in online banking, but nonetheless, despite these being dependent on the severity of the crisis, we will see channels like branch banking and ATM still having a very relevant role into the overall mix of customer interaction. If we look at Southeast Asia, and we look at a recently refreshed statistics and analysis out of Global Data, the preeminent research organization that is of which Retail Banker International is part of, we have a very similar situation. So first of all, what strikes out of these numbers is how some specific markets, like for example, Australia, are very much online driven, with online banking and mobile banking capturing the vast majority of the intention to use of customers compared to branch banking and telephone. While on the other side, we have countries like Indonesia and Thailand and Vietnam that, despite the very rapid adoption of advanced value proposition, platform solution, customer journeys solution, and so on, are still nonetheless seeing a very attractive response from customers towards branch banking and telephone banking. So overall, if we have to look at this picture, one of the messages that we can take is that different countries are moving completely differently, and it is the characteristics and the willingness and the desire of customer to use a specific channel that should balance out our decision as bank on how to optimize cost. Branches and physical channels like branches and ATMs obviously are more capital intensive and resource intensive than others, but nonetheless, we need to balance them out in order to maximize uptake, keeping in mind customer user experience and customer satisfaction. One particular element that we have to keep in mind is that we have a product life cycle, and different channels are used across the product life cycle for different steps. So we got the information gathering, the consideration for a product, the application, the use, the services, and the closing. And each of these steps has a completely different value of the interaction for the bank, for the financial services institution. Having the ability to interact and influence and to address questions at information gathering and consideration level is very important. And guess what? These are channels where banks have been pushed so far to be very passive actors through online interfaces, marketplaces and comparison platforms and so on, hence losing the ability to interact with the customer and somehow having a diminished lever to influence the buying decision. So overall, whenever we're thinking of a channel mix, obviously it's not possible to take customers out of digital into a branch, and that would not be desirable. But we need to keep in mind of ways of how to better optimize all of these all of these touch points in a way to maximize value from the customer and have the ability to better compete in the market with our own product. So there is a usage customer preference and channel cost optimization priority that need to be optimized. And this is taking us to our conclusions. So banking is just dealing with a global pandemic that is changing society. We will have a long-term effect that are difficult to predict, but overall, the channels will still operate within a level of complementarity. So despite the significant shift to digital, and physical channels will still be complementary and will have value on their own that cannot be ignored or mismanaged. Distribution channels are resource-intensive assets, and these need to be optimized within the realistic understanding of the cost and value in terms of customer interaction and value for the use within the intended strategy by segment, by desired positioning, by products that are taken to market and so on. And then finally, while there are best practices that can be referred from other countries, there is a need to understand and tailor the response to the characteristics of each market. There are lessons learned and amazing case studies that need necessarily to be customized and put within the context of the market and the segment preferences within which we are operating. And with this, I hand over to Doug for the final part of today's event, and I thank you for your attention. Over to you, Doug.